Hi, Mark Orr from sellmybusiness.co.nz, business broker with tobacco business sales licensed under the REAA 2008. Thanks for joining me. I've put together this short presentation in 4 parts around the art of business appraisal. Throughout our business, we always get asked by clients in regards to the process of business valuation. So I put together this 4-part series that will hopefully give you an in-depth overview of the actual process itself. In New Zealand, by law, we're obligated to provide a full written fair market appraisal for our vendors. So I hope this will be of interest. The topics I'll cover are return on investment firstly here today, then also in part 2 valuation, how we arrive at an asking price and whether it really is rocket science or not. Thirdly, goodwill and intangibles, what are they and why they're important in a business valuation, and how and why they affect price, and what questions business brokers ask during the process to get a good internal and external operational understanding of the business, and how those factors will ultimately affect the valuation and sale price. So to get us started, return on investment, why buy a business anyway? Most people that I deal with here regionally are really looking at businesses in the earnings before proprietor interest, tax and depreciation range. And in this way they are looking to work full-time within the business and draw a good solid salary out of it. Most have been working for other people throughout their lives and would like to have a go at being involved in their own business and therefore generating income for themselves rather than for someone else. It's always crucial that you're looking to receive an income over and above that of a reasonable salary for your role. Otherwise there's not a lot of point in investing in something with a higher risk in order to receive less money than you could just for working for another party. In this instance, we'll be looking at an EBIT business, earnings before interest and tax. These have a consideration for a wage to a manager and also an allocation for depreciation. And in this case, we're looking at something to say if we had $1 million, what kind of a return we could expect via various investments. In New Zealand at the moment, our bank deposits are returning 3.5% to 4%. If you were to put $1 million into one residential property, and I would say here up front, I'm no expert in the property market, but I would imagine you should expect at least $750 per week return for a residential property, giving you around about $39,000 per annum return before tax. There's obviously got to be some capital growth there. I think over the long term it would be a fair punt to say that 6% would be a reasonable return to expect. Commercial property here locally in my bigger city, Dunedin, I personally would be looking for perhaps 7 to 10 which might be a bit optimistic in today's market, but it certainly has been achievable in the past. And there's also capital growth here, probably less than the residential side, and it's slightly more uncertain going forward. And then finally, a return on buying a going concern EBIT business. Most people's accountants or their advisors should be suggesting that they would be receiving around about the 25% or upwards as a return, and that would be after an owner's wage and costs. Obviously, the higher return from a going concern business is a reward for that increased risk, and even during the life of a business, their values will fluctuate up and down, and this would depend on the internal factors, the profitability and the owner's input of the business, and also the macro external factors, or whether you're in a recession or there's some kind of industry changes that directly affect that business. So for a $1 million investment, we're basically looking at from the current bank rate, $35,000 to $40,000 before tax plus your J job. If you were to put your $1 million into residential property, approximately $39,000 plus your day job and some capital growth, but always remembering that you can't necessarily eat that capital growth, that it doesn't pay for your groceries. Commercial property, $60,000 to $80,000 return plus your day job and also some capital growth, but at a slower rate. And finally, investing in an EBIT business, a return of 25%, giving you $250,000 plus you would expect a wage for management. which would be set by whatever the industry standard was. But I would imagine for an EBIT, good quality EBIT business, that would be north of $100,000. So just to recap, we've just quickly covered their return on investment and the type of money you can expect from an investment in the various vehicles, be they property, term investments, or as suggested, an EBIT business. Next I will cover valuation and how we arrive at the asking price. Thirdly, I'll get into the goodwills and intangibles and what the difference is, what they are, and what kind of a component they make up in any sale price. And lastly, I'll cover over the nitty-gritty of questions that business brokers ask in relation to discovering the operational side of a business, which is very important in determining the overall valuation price. So that's all from me right now. This is Mark Orr from sellmybusiness.co.nz. Please feel free to visit the site to discover more free and useful business sales information. Until next time, I wish you the best of success.